Good afternoon, everyone. I'm Mike Pacito, Director of Institutional Relationships for the PartnerSelect funds at Lippman Gregory. Thanks, everyone, for joining us. Today, we're having a conversation featuring this with Lippman Gregory CIO Jeremy DeGroot and the founder, CEO, and CIO of DoubleLine, Jeffrey Gundlach. But first, a brief update and outlook for the PartnerSelect Alternative Strategies Fund with co-portfolio manager Jason Steuerwalt. Now, a quick primer on the fund, as many on the call today own it or may be considering owning it, but others may not be familiar with it. This is our flagship liquid alternatives fund with 5 unique underlying separate accounts within: Contrarian Opportunity from First Pacific Advisors, FPA, Absolute Return from Loomis Sales, Long Short Credit from DCI, Arbitrage Event-Driven Special Situations from Water Island, and the largest weighting within the fund, Opportunistic Income from DoubleLine, managed by Jeffrey Gundlach and Jeffrey Sherman. Since the fund's inception in 2011, the fund has handily beaten its Morningstar category, the HFRX, and the Barclays Agg, and with a negative correlation to core bonds with nearly twice the yield, alongside a very low beta to equities, it's been an excellent diversifier for fixed income and a ballast in volatile equity markets. Please feel free to punch in any questions you may have for our presenters today in the Q&A section, and we'll also try to get to the questions that were sent in to us in advance. With that, Jason, I'm going to hand it off to you for a quick update, how the fund is positioned and our outlook, and then we'll get right to Jeffrey and Jeremy.
Great, thanks, Mike. So I'll give a quick recap on the year and then talk a little bit about the managers. The fund was conservatively positioned coming into the year based on high valuations in equity markets and tight credit spreads. There was a high cash level in FPA's sleeve. Water Island's portfolio was overwhelmingly hard catalyst, short duration, merger focused. Loomis Sales had almost no high yield exposure, with almost 2/3 of their exposure in short duration, high quality investment grade and structured credit. DoubleLine had about a quarter in agency or government paper and about 50% in legacy non-agency RMBS, which was yielding about 4% or so. So really not far out on the risk spectrum. The year started off relatively smoothly, and it was playing out about as we would have expected even through the early stage of the crisis. The fund was down low to mid single digits, even as the S&P was down over 20% from its peak. But the fund wasn't spared from the rolling market shocks as the crisis intensified. There was a lot of forced selling from hedge funds in the merger space and especially in the credit space. Hedge funds, mortgage REITs, even mutual funds had BWICs out trying to reduce their exposure and raise cash. It was a little bit like the GFC condensed into a 2-week period. So tough times across credit markets. Fortunately, our low beta, less correlated strategies held up relatively well, and our managers were generally able to pivot to being more aggressive to varying degrees. And that's really a core element of the fund's strategy, investing with managers that have been through battles like this before and know how to navigate these situations. So a couple quick examples. Loomis took off the hedges from their portfolio and moved fairly aggressively into high yield, including fallen angels and even investment grade that had gotten really beaten down as investors were forced to sell whatever they could to raise liquidity. Water Island added to deals that they liked best, that they felt had really strong merger agreements at what in retrospect were really extraordinary spreads. FPA added some high quality travel related names that not surprisingly were extremely beaten down, but that they felt had strong enough balance sheets to weather a prolonged downturn in travel. These moves paid off handsomely as the fund gained a lot of ground in Q2 and was in the black by the end of Q3. And through the end of last week, the fund was up about 3%, with 4 of the 5 managers in positive territory for the year. 2 of them in the high single digits, Water Island and Loomis Sales. We still really like the return potential going forward. I'll briefly run through the managers to give a little bit of color on that. So starting with DCI, this is our systematic long-short credit manager that combines a market-neutral long-short CDS portfolio with a cash high-yield bond sleeve that's hedged with CDX and Treasury futures. So they still see an attractive spread opportunity. The average spread on their CDS book is above average, meaning there's good potential for convergence between the longs and the shorts towards their estimate of fair value. They tend to do best in a widespread environment, with reasonable volatility and one that's driven by fundamentals. So we think this should be a good environment for them as the market becomes more discerning between improving and declining credit quality. And it's not just driven by shifts from greed, extreme greed where everything sells off to, extreme fear where everything sells off to extreme greed where people are chasing things on the way up, which is what happened in March and then after the Fed and Treasury stepped in on the way up. Moving to DoubleLine, about 50% of the portfolio is still in non-agency RMBS, with another third in other credit sectors, mostly in structured credit, primarily CMBS, CLOs, and other ABS. It's got a healthy yield of almost 6% and a duration of only 2. So these are the sectors that were most impacted by the forced selling among other market participants during the March period and didn't benefit directly from the Fed and Treasury measures immediately following the crisis. So they've kind of lagged the sharp rally in high yield and investment grade on the way back up, which is part of the reason there's still quite a significant yield in that portfolio. And also what we think is a really favorable upside downside return profile, as a lot of that book is still below par. But the monthly remittance data comes in and shows the underlying performance of those the loans behind those securities better than the worst case expectations that the market had expected. If we can move to FPA. This portfolio was hit a little bit harder than we would have normally expected given how it was positioned coming into the year. And that's primarily because it had a decent, not huge, but decent exposure to financials and a couple of aerospace names, which although they were fairly conservative with a lot of recurring maintenance revenue, nobody really expected a almost complete shutdown of air travel for a long time. So nonetheless, they were able to pivot and add to some names, added a couple credit names. Currently stands about 70% net long equities, about 5% credit, and almost a quarter in cash. I think of this portfolio really as barbelled between some dominant high quality business models. You can see a couple names here, Alphabet, Microsoft, and then on one end, and then some extremely cheap but more cyclical sectors, financials, some materials and industrials on the other end. And this portfolio is really poised to benefit strongly if the value rotation continues. And they also still have a lot of dry powder to be opportunistic in the event of further sell-offs in either the credit or equity markets. Moving to Loomis sales, if we could, thanks. As I mentioned, Loomis was conservative coming into the year, almost no net long high yield exposure at all. But they were still hit a little bit in March, given the complete liquidation of pretty much everything in the credit markets. They pivoted pretty aggressively to high yield, and that's been a strong driver of performance this year. They've still got quite a bit of high yield, but they've reduced it quite a lot and gotten more conservative, given how much spreads have tightened over that time period. You can see the yield to worst here is still over 5% with a duration of about 4. And lastly, Water Island is the best performer in the portfolio year to date. And I mentioned before, they added to a number of their favorite deals, the ones they felt had the strongest merger agreements that were pretty much bulletproof in March at, again, really just unbelievable levels, spreads you only see in the midst of a crisis. So the vast majority of their net exposure is still in the merger book. And we think there's still a good opportunity set there. Spreads wider than pre-COVID levels and a big rebound in deal volume following, not surprisingly, a big fall off in Q2. There's also a decent allocation to special situations in that sleeve of the portfolio. And the majority of that is in the SPACs, and Water Island participates in the SPAC universe across the deal life cycle there. It's been a really nice contributor to returns year to date, and still a good opportunity set going forward amid record issuance this year, which continues to be strong. So overall, I'd say we feel pretty good about the performance year to date. And we think there's a lot of upside left in the more directional parts of the portfolio, as well as a good environment for the relative value and arbitrage strategies. So with that, I will turn it back over to Jeremy.
Okay, thank you, Jason and Mike. It's my pleasure to welcome Jeffrey Gundlach to our call, and for the remainder of the time till about 1 o'clock to have a Q&A discussion with Jeffrey. I'm sorry, let me get my screen here so I can see you. Welcome, Jeffrey. Good to see you again. How are you doing?
Well, I think you forgot to set your clock back. I think it's already 1 o'clock.
You're right, sorry. Well, thanks for joining us. That was very instructive. Sorry about that. 2 o'clock. I'm in California. Are you down in LA or are you back east?
No, I'm here in Pacific Palisades. Yep.
Okay.
I went back east a couple of times during the summer, but I'm staying out between now and, let's say, early April.
Would think that would be wise. So just to set the stage here, our intention is to kind of go from big picture and get an update on your macroeconomic view, see how that feeds into Double Line's view of the investment opportunity set, the financial markets, near term, longer term, and then also dig in a bit into some of the specific risks and opportunities within the fixed income world and the opportunity set that you have to work from for the opportunistic income strategy that's part of our alternative strategies fund. And we've gotten a number of questions in advance that were written in from listeners that I'm incorporating in here, and we may get some live ones as well. So, a lot to cover, but why don't we just jump in and start with your big picture macro view. And I think there were a couple of people that referenced this, and I thought a nice way to lead into it would be to just see if, given the election results, presidential and congressional, that we've seen, and I guess somewhat still playing out, if that's changed your near-term or longer-term view and setting the stage for your broader macro outlook.
No, not really. My highest conviction idea relative to going to the election was that there would be no blue wave. That if Biden won, and maybe he did, maybe he didn't, we'll find out, but it doesn't really matter to a certain extent, because no matter who won, I was pretty certain that the Congress would remain split. I thought that there was a horrible logic underneath the narrative that since Biden was way ahead in the mainstream media polls, which we all knew were overstating his support, just as it did in 2016, a lot of people thought that true to historic pattern, you would get down ticket benefits. So if Biden was going to win by 12 percentage points, which I think was what CNN projected the day before the election, which wasn't even close, people thought that that would lead to gains in the Senate and therefore the blue wave thesis. I had exactly the opposite opinion. My point of view was and is that people didn't really vote for Joe Biden so much as the people that were in his camp were voting against Trump, and they would vote against just about, they'd vote for anybody against Trump. I made the joke they would vote for an empty garbage can instead of Trump. And so that you coupled together with the fact that many Americans, and I think it's about 2/3 even of Democrats, believe that Joe Biden, if he gets inaugurated, won't make it 4 years. So in the back of people's minds, I think, was Kamala Harris, who is much more outspoken and direct in her opinions than Joe Biden, who is highly evasive and malleable in the way he speaks about issues. Kamala has spoken pretty seriously about some of the leftist agendas. Some people say that organizations that are, they call themselves bipartisan, they probably aren't really, but they say that she's got about the most liberal voting record that there is. So I figured that people would want an insurance policy. They would be in the back of their minds, they were thinking, well, I didn't want Kamala Harris. She dropped out with almost no support in the primaries. I don't want Trump, so I'm gonna hedge my bets and I'm gonna keep the Republicans in charge of the Senate. And that took place. And I actually think that as the narrative was shifting going into the election and immediately after the election, the real narrative is what I'm talking about here. It wasn't that, look, the market's up, so people like Trump, and then all of a sudden, wait, the market's up more, and so they might like Biden. I think it's what they like is as little uncertainty on future policy as possible. They certainly don't want higher corporate taxes. If you own the S&P 500, you certainly don't want higher corporate taxes. that is one thing that Joe Biden seems committed to, at least partially. So I kind of think that the market likes this sort of divided situation. There's talk now that there's going to be a descent, a bunch of Californians descending into Georgia to vote in the runoff election to try to flip the Senate. I think that got started because Andrew Yang said so in a tweet, the failed Democratic hopeful. He said he's moving to Georgia, and so he can try to help flip the Senate. Now, I wonder if that's possible, if you're allowed to vote in the runoff election, if you weren't a citizen for the general election. I kind of doubt it, but that's taken on a life of its own in our social media world. And so there's a bunch of people trying to recruit others of Californians to ambush Georgia. I sort of doubt that's going to happen.
Yeah.
But anyway, so we've got this divided situation. It leads to probably less of the dream case for stimulus. Mm-hmm. If you were looking for a blue wave, you probably would have gotten another multi-trillion-dollar stimulus package. This one, I'm getting very confused as to why we're talking about stimulus packages. Jay Powell, I think it was this morning, said that he's thinking about, there was some Fed official, I don't think it was Powell, that said they're thinking about raising interest rates. And I think Bank of America put out a research note that we should start bracing for higher short-term interest rates. And then in the second part of the research piece, they talk about the stimulus package, which sounds a lot like putting on the gas and the brake at the same time. So I really believe Jay Powell that they're not going to raise interest rates in a very long time. And he's also gone so far as to say that in the next downturn, which I think we're still sort of in the downturn, they're not going to do negative interest rates. They're going to do large-scale asset purchases. And that's what's got the bond market all screwed up. We've had about the lowest volatility summer into the fall in my career. It probably is the lowest volatility, where the range is so tight. It was actually only a 20 basis point range. It finally broke a little bit above it a couple of weeks ago, but we're right back essentially into it with the 10-year 87 basis points. And so the election, I think, is ended kind of like the last several elections with a divided government. Trump will probably, I think, go kind of crazy with more draconian measures on China, particularly if he's has to concede. He would want to leave his footprint on being tough on China is one of his signature issues. I hear he's thinking about that. So those are things we have to brace for. So election it is odd that it's not really over yet. The runoff in Georgia's I think it's January 5th. So there's still quite a lot of time to go, and that's going to be the most important issue. My betting is that the Republicans will win at least one seat and hang on to a 51 vote majority.
Yeah. So let's talk a bit about the economy. I mean, you said maybe we're still in a downturn. The last two quarters, I mean, second quarter was obviously the worst quarter, for GDP in U.S. history. So coming off of that, a huge growth number doesn't necessarily mean that much, but the economic indicators, the PMIs and manufacturing service and so forth, are indicating expansion mode. I guess I just want to get your sense of nearer term, how you view the risk of let's call it a double dip or another downturn reverting from this recovery. And it would seem that COVID is a key. COVID and policy are kind of the two variables we've been talking about, is really driving, the nearest term macro outlook. And so you touched on policy. Fiscal policy clearly is more up in the air now without a blue wave. And so that's one piece. COVID is another, but I guess the risk of just the economy in the short term and what that would mean for financial markets.
Let's not kid ourselves. The economy recovered because of the most unusual policy response in American history. I think that's not even an exaggeration. I mean, it's the first economic downturn, and this is a big economic downturn, but it's the first economic downturn where we actually had an increase in personal disposable income. And that increase was due to $3 trillion of transfer payments. Now, that's what's keeping the economy going. If you don't have those transfer payments, you have a lot of permanent unemployment. You have a lot of small businesses that are already closed for good. And there are many more that are going to close in the wintertime that's coming up here. The most recent data point that I saw, 24% of all small businesses that were open at year end 2019 are closed right now, 24%. And so you had an increase in consumer spending, unbelievably, thanks to the transfer payments of the government. That's just unheard of. And obviously, a lot of the money made it into financial speculation. You can see that in the number of retail accounts that have been signed up for, the volume of trades, the incredible amount of call buying that was going on in micro slices, thanks to the financial engineering of Wall Street, which is more than happy to help the retail investor participate with government money in the market. But I think the economy has a lot of structural unemployment in it right now. And I think that unemployment is going to climb up the income ladder. It first hit, of course, very low income people. There were a lot of baristas laid off, and waiters and bartenders and cruise ship janitors and all this hotel workers and all that stuff. But one thing that I think a lot of observers have failed to really think about and appreciate is work at home has changed the way that I think CEOs analyze their business. And I'm just anecdotally seeing through my clients that are financial intermediaries, there's a lot of layoffs going on. We run, our biggest client runs a huge variable annuity programs insurance company. And they informed us a few weeks ago, they were laying off hundreds of people that were in their kind of wholesaler unit and that sort of a thing. And they realized, first of all, that the environment isn't really conducive to traveling salesmen right now. And they also probably realized that maybe they didn't really need all those people anyway. And that's happened in my own business, where thanks to virtual meetings, which we have every day, of course, like everybody else, and working a lot by email, you start to get greater clarity on who's really producing what. You know, it's one thing when you're in an office building and you walk down the hall and you go to the manager of an investment team and you say, I'd like this report or this data set. And a few hours later, they give it to you. But then when you send it out to the entire team, so the email goes to 12 people or something, and you start to realize that it's always the same 3 people that are getting back to you. And they get back really quickly. And the other 9 people get back, well, let's just say, let's say it's a dozen. 6 of the other 9 people I haven't heard from since March 13th, when we went to work from home. And then you've got 3 others that are kind of sometimes showing up. And you start to wonder why you need that manager who you haven't heard from since March 13th. And you start to realize that they're just watching other people work. And I think that happens. And I think that the unemployment is going to climb the economic ladder. I've furloughed a couple of people just because I just couldn't for the life of me figure out what they were producing. And so I think that's going to continue to happen. What we've seen is highly unreliable economic data. I think that's one of the most important points for people to consider. The economic data is completely skewed by the seismic shift in the economy. Our average hourly earnings really going up. They sure look like it, particularly in the middle of the year, but most of that was because the low wage earners were the ones that got laid off. So the data sets are all non-comparable. So you mentioned the PMIs and by extension, industrial production. Sure, they look great. When you dig a hole that deep, when you come out of it, it looks great. I mean, we talk about portfolio performance this year. If you look at the last 6 months, certain types of portfolios, like my sleeve and your fund, it's up like 10% in the last 6 months. And it's like, wow, I mean, this is doing great, but it's not all the way back. It's like that thing, you go down 10 and up 10, you're not back to 100. So I think this data is really murky. And I do believe that this economic hit is very uneven across the economy. It's been a real shock, I think, to the middle management community that is above middle class but isn't truly wealthy, that usually lives on debt, usually doesn't have any savings. We always saw those statistics pre-COVID that so many Americans don't even have $500 saved. I've got to believe that the people that with no savings that were living, loan to loan in their debt-based reality, they must have been scared to death in April. Because if you have no savings and you're used to a comfortable lifestyle and you're starting to think about layoffs happening, I just think it puts the fear of God in you. So I think the savings rate Well, I know the savings rate is elevated at higher wage levels. It's consumer spending at higher wage parts earners in the economy is still down a lot. And I think it's a dangerous word, but I'm going to use it. Never going to go back to where it was pre-COVID, because those people are starting to realize that they need a rainy day fund more than they need another credit card. And so I believe that consumer spending is going to be hit. And I think that this general economic shock, at least initially, is deflationary. Certainly we saw that immediately in the aftermath of lockdowns, and it's come back somewhat. But I just think it's disinflationary, deflationary on wages. I think there's going to be changes. We're already seeing changes in mobility. People don't want to live in densely populated cities as much as they did, particularly now that the taxes are being raised and the police are being defunded and people are looting stores in some of these cities. I just think there's a movement there that's really powerful, and I think it's deflationary. I think it's deflationary for San Francisco County home prices, where the units that are up for sale is like 4 times as much as it was in the last 5 years, which were all pretty similar. And you're seeing a lot of people trying to move to Boise and Austin and all that stuff happening. And those are cheaper areas to live, at least for now. And you have to pay lower, you don't have to pay as high a wage. If you're an employee that's decided, let's say you're an IT person, you were paying a lot of office space in downtown Los Angeles, like I was doing for these people. And they're basically just typing a computer all day anyway. And my IT department has told me, they told me this months ago, they don't think they want to go back to work at the office ever, and they don't think there's any need to. In fact, they make the argument, and I completely concur with this argument, that there's actually a productivity benefit for an IT team to not commute to their office, because they can be typing at their computer and coding instead of looking at the bumper in front of them.
Right.
So I really think that this is a kind of a negative, a long-term structural negative to the economy. But more than, again, my fundamental point is the narrative that you hear all the time, getting back to normal, like it's going to go back to pre-COVID. It's not going to happen. There's going to be benefits that come out of what we've learned from this, and there's going to be losers from out of it. And we're going to have to watch it sort out. But initially, until such time as they go hog wild with money distribution, I think as we're doing it with lending facilities via the Fed, I think it's still disinflationary.
Okay, so that's good segue into I guess the Fed and also bond market interest rates, obviously so closely tied to inflation expectations. So let's first just quickly touch on the Fed if we can. They've introduced or discussed this average inflation targeting framework where they're saying we're really, we're going to let things overshoot. Obviously the huge bond purchasing, the lending facilities. I mean, they threw everything, all the kitchen sinks they had, and they're saying we've got more sinks back in the closet if we need them. And I think it was Powell did today. I mean, basically reiterate again that I found the quote here. Well, the Fed is strongly committed to using all of our tools to support the economy for as long as it takes until the job is well and truly done. And he's saying, it's not time to put any of our tools away. So.
Yeah, he sounds like he's preparing. He sounds like he's preparing people for more for the Fed to ramp up their activity a little bit more. Yeah. They've been kind of calm for the last few months. They did trillions of dollars of purchases. They violated their own charter. They're presently in violation of the Federal Reserve Act of 1913. They're not allowed to own corporate bonds ever, and yet they own junk bond ETFs.
Right.
So what's concerning about the Fed is, since they are operating in plain sight, in violation of their own charter, it means you've kind of crossed the Rubicon. And now anything kind of goes. Once you violate a fundamental aspect of your charter, why not violate all of them? And so the danger is that the Fed ends up kind of supporting an inflationist regime. They're not there yet. They would actually have to go to a radical step of declaring their liabilities legal tender, which would be true money printing. What they're doing now, a lot of people call it money printing, but it's technically not. And it's a very wonky distinction. It's not really worth going into, but you'll notice that we haven't had inflation go up. We've been running global financial crisis policies now for 12 years, if you think about it. I mean, interest rates now, they're basically, it was funny. I was looking at a webcast that I did in 2011, about 2 weeks ago, and it was shocking how applicable the environment that was represented in that webcast slide deck is to today. The interest rates were the same. The Fed's balance sheet was a big issue. You know, when are we going to get off zero? When are we going to get inflation higher? One way to think about this, and employment is actually kind of today about the same as it was in 2007. So one way to think about this is we've never left the global financial crisis. We have exactly the same policies that we introduced to fight the global financial crisis. We're talking about amping them up to new highs. And we have the same employment basically, and we still have the same debt-based economic scheme. If what we're doing right now, even if you put it on steroids a little bit, if you believe that that's going to run into inflation, how come you don't have inflation yet? It's because as you have a highly indebted economy that this is, the more debt you pile on, the less effective it is in generating economic growth per dollar of debt. And in generating both economic growth and inflation. So this is kind of the paradigm we're stuck in. What the Fed wants is it's interesting how they kind of massage you gradually into accepting a position that if you jumped there in one step, you would find very radical. Remember how it used to be a ceiling of inflation at 2%, and then it was a target of 2%, and now it's a target above 2%, at least for a while, so that you can make up for past sins of being below 2%. It's pretty clear the Fed wants to monetize the debt, and they want to do it very slowly. They want inflation to be higher than the interest rate. And right now it sort of is. I mean, they're kind of close, but the interest rate is sort of higher. The Fed understands that $157 trillion of unfunded liabilities in the United States cannot be paid back in today's currency value. It can't be done. You have to either restructure those liabilities or you have to debase. One way to start debasing is to get the inflation rate higher than the interest rate by a fair amount. And that's what their target is. So the Fed isn't just willing to let inflation run hot. They want it to run hot.
Right.
I think they'd be thrilled if the inflation rate went to 3.5%. And if it stayed there for a couple of years and the 10-year treasury stayed at 1%, you'd be on your way to taking small steps anyway to get at this liability problem. And now one thing that's also interesting is that average hourly earnings, which is a tricky number because as I said, the data set has shifted a lot, is higher than the 30-year mortgage rate. So right now we're actually helping to debase mortgage debt on average. There's a lot of oversimplification in that analysis because first of all, average hourly earnings can go up next week and your mortgage rate is locked in for 30 years. But if it stayed with that dynamic, you're actually right now helping to debase the mortgage debt. And you're getting to the point where if you could get the inflation rate up to 3%, you'd start to debase corporate debt as well, because the average yield on corporate debt now, at least at market, is about 1.7% in the investment grade market and 2.25% in the triple B market. And there's an awful lot of danger in the triple B bond market with the size that's grown to and what happens to triple B bonds if they get downgraded into junk. Spoiler alert, they fall a lot in price. So it's highly attractive to do a slow motion and maybe you start to put the accelerator on a little bit, debasement, and that's what the Fed wants to do. And so that, I believe, kind of characterizes what's happening at the Fed.
So let's talk about the investment implications. I mean, that, as you describe it, it sounds like, gee, I sure wouldn't really want to be a bond fund manager.
Well, for now it's okay.
Right. So the timing of it, right?
There's still, I mean, the moment you felt like you didn't want to be a bond fund manager was probably about February 20th, when yields fell on treasuries, at least initially on the short end. So there was no yield there. And yet you had all this risk of overvalued stock market, overvalued corporate bond market, and everything else at very tight spreads as well. What's happened, of course, the Fed instantaneously ratcheted the corporate bond market back to its old highs by violating its charter. High yield bonds haven't bounced all the way back, but they're back a fair distance. And so the Fed has supported those areas. Now one way to think about that is maybe it takes some of the risk away. I mean, maybe you don't have to worry about it. If the economy hits another speed bump and corporate bonds drop another 20 points, maybe the Fed just pegs them back up 20 points again. I don't think that's a very good investment thesis, that they're just going to hope that happens. And also, I think that the corporate bond market at the yield that it's offering relative to its duration is kind of nutty. I mean, let's just say it's a duration of 9 and its yield in the investment grade category, the duration's 9 and the yield is 1.7. It doesn't sound like a good way to make money. When you have the risk of a economic downturn that could lead to downgrades in corporate bonds, you would lose probably 10 years of income. If they're 10-year maturity bonds, you kind of lose all your income in the downgrade and the ultimate default. What opportunities do exist are in the things that the Fed didn't protect, and they're kind of wonky and esoteric, and they have obvious underlying concerns about them. So that's in commercial mortgage-backed securities, and it's in asset-backed securities, and it's in those type, and it's maybe in tranched out corporate credit in the CLO market, because those are areas where you have an identifiable reason to get nervous. You know, it's like hotel bonds, cruise ship bonds. Well, you know, maybe it'll be okay. But when you get into these capital structures that are tranche, which is CLOs and CMBS and parts of ABS, it's actually a really good opportunity. It was really great 6 weeks ago, but with the vaccine news, they've started to, I mean, it's going to be a pretty strong month for CMBS and CLOs and stuff like that, because the vaccine news popped the middle of the capital structure a lot, but that's been the place to be. So if you look at the CMBS market, we looked at where the cliff was in various segments of the market. And we decided that almost nowhere in the BBB CMBS market will you take a loss. Even if you stress to double the global financial crisis defaults and knock 20 points off of the recovery rate, you're still money good. And some of these securities were trading down at 50 and 60 cents on the dollar. They've rallied, of course, but now they're up maybe at 82 or 85. And there's still room for these, we believe, money good securities to go up another 15 points. And so there are areas of the market. So we have about 25% of our portfolio we're managing for you all in those exact types of things, middle of the capital structure. They lagged a lot, the corporate bond market in April and May, when the Fed was targeting their programs. AAA CMBS snapped back completely because the Fed actually made them eligible for some of their lending facilities. But then what happened in most recent months is opportunity seekers started to realize they were getting more and more data on the COVID fallout. And quite frankly, the remittance data, the non-payment in CMBS, and even in CMBS, but particularly in RMBS, it's been shockingly subdued. I mean, the amount of non-payment is really low, and it's been falling gradually from its spike in April, May. It's been falling ever since. And so I think that the fallout appears to be less than we would have feared. So certainly a double the default rate of the global financial crisis was probably overly conservative, but better safe than sorry. So those parts of the area. Now, the other thing that we've started to think about is a weaker dollar getting more in gear. I've been negative on the dollar since January of 2017. Yep. And I actually turned positive in the short term on the dollar for a trade back in August. It hasn't really worked or not worked. It's basically gone sideways since then. But there is a strong correlation between the size of the twin deficits and the direction of the dollar historically, and for good reasons. And the trade deficit doesn't matter anymore. It's actually shrinking a little bit because world activity slowed down somewhat. But the budget deficit just blows it away. I mean, it's at 16% of GDP. It's just unheard of. We've never seen anything like this. And it strongly correlates to a weaker dollar with a 2-year lag. So I think the weaker dollar is probably going to get in gear fairly soon. And for that reason, one who's a dollar-based investor can start thinking about currency trading, currency bonds. And in this case, I wouldn't be buying Japan or Europe with their negative yields. I made a promise to myself I would never buy a negative yielding bond, and I've kept that promise so far. And if the market ever, if the market can ever have any positive yielding bonds, I'm going to stay there. But emerging markets should do pretty well. A great COVID play, if you believe in COVID-based improvement, yep. Emerging market debt's a great place to be. Emerging markets equities are a great place to be because they, just like CMBS and airlines and cruise ships back in May, emerging markets were an area that people are really worried about COVID because the healthcare systems aren't as strong and the like. And yet a weaker dollar would really make them do well. And emerging market equities have been a mixed bag this year. The Latin American ones were negative. They've rallied pretty sharply in the last several weeks, but Asian emerging markets are up like 20% year to date. It's kind of shocking to see that divergence. I think the weaker dollar will create investment opportunities. And we haven't had a really weak dollar since really the middle of the 00s. So
Yeah.
that is going to be an important investment thesis. And we added some emerging market debt. We have about 5% in our portfolio. That was sort of an opportunistic thing because the market was down a lot. But I also think fundamentally we could very well be increasing that as we move forward into 2021.
And I mean, the dollar was a question on the list, and I think you covered it well. A couple other points that it does seem to be a consensus view, at least medium term, for the dollar depreciation. Some other points in addition to the deficits, the real yields that have come down in the U.S. Real yield curve relative to other currencies, that's compressed rates. We don't have that advantage. And then related to the kind of global recovery, U.S. dollar is a safe haven typically. So if global growth rebounds, that tends to be consistent with a weaker dollar, which is beneficial for foreign markets and equities. And
yeah, I think that the sentiment for the weaker dollar got to such a high level. It's part of the motivation for why I took off my bearish view, because it really was almost 100% dollar bears, and particularly against the euro. And the euro has rallied. The dollar hasn't rallied so much against emerging market currencies, but it has rallied a fair amount against the euro, which is an important one. So yeah, the one thing I think about though is dollar, when to be a safe haven, kind of means in the near term, I think the strong dollar would probably be associated with a weaker stock market, because that's certainly what happened in March and April, and I would expect that would happen again.
So let me touch on emerging markets, and this was a question I had on my list, and a couple of others asked as well, and specifically about China. You've expressed positive long-term view on India and Indian equities and the opportunity there, but I don't recall you talking as much about China, and so just wanted to get your view in terms of investment opportunities there and how you view the risks. And
I've never gone long or short Chinese equities. I just simply felt that the nonstop growth, the debt level, the shadow banking system, all that stuff. But given the relative performance and kind of the situation that's developed, global tension a little bit, I'm actually sort of turning positive on China as an investment possibility. They have a tremendous credit impulse that's going on right now, and it probably will filter through into stronger economic growth. And by the way, that credit impulse is a very strong indicator of rising industrial metals prices, or industrial commodities prices, and that's already begun. Finally, it was going down forever, but that leads with about 12 months, and the credit impulse has turned very positive. So I like kind of Asian emerging markets for lower risk investors. I like India for long-term investors, and at this point, I mean, if you're a high risk profile person, I would contemplate South American, Latin American equities, which I hadn't been at all fond of prior to some of these economic developments looking a little bit rosier.
Okay, one more on the equity market. Just curious of your take on it. There's of course been it's now about 13 years of growth outperforming value, just to broadly define them.
Yeah.
And that's been the endless bet is, okay, the rotation is happening. Now we've seen value actually has had a couple month run in the U.S. and
it's been pretty strong lately.
The Pfizer news was, I mean, that day was one for the record books. I saw some research firm saying it was a 12 standard deviation event, which is 1 trillionth to the X power of
I think it's 10 to the 48th power.
Okay, you've got
yeah.
So either reality is wrong or the models are wrong. I'm going to bet on the models being right, but I don't know. You might have it. No, I'm just kidding.
Yeah.
So just kind of your within the U.S. equity market. To me, it ties into the view on global growth and whether people see that as sustainable versus, kind of these defensive long duration growth stocks at very high multiples, but are actually earning something in this, challenging environment. In fact, have gotten competitive advantages right from stay at home. So
I kind of think all these trends go together. I
Yeah.
think that we've had really persistent trends of value underperforming growth, of the US outperforming every other market in the world by a mile,
yeah,
of the Super Six being the all of the growth in the S&P 500. I mean, if you look at the S&P 494 smaller cap names, until very recently, they had a 2-year return of zero.
right.
Just nothing was going on. I kind of see this COVID situation and the government response and all of the fallout from it. I kind of think that you can sort of see the wind turning. You can sort of see, I believe, that these seemingly forever trends, I think, are one by one starting to fall by the wayside. And so it kind of goes to that bigger picture that I think the US will underperform in the rest of the world stock market as the dollar is weak. I think value will outperform growth. I think commodities will outperform stocks ultimately. I believe all of these things are changing. And so I believe interest rates would start to rise very rapidly. We'll have to see what the Fed is going to tolerate in terms of rising interest rates. If they're really committed to pegging the yield curve, they've used the word yield curve control. They did it in the 1940s and the 1950s for many of the same reasons that you might do now. So I think a lot of these things are changing, and I've been talking about this for a while, and it works in like glacial time. People they want to put a trade on, have instant gratification, but we're talking about very long trends. And I would actually take the lens out on an even wider zoom. And that is that in 2017, there was the lowest volatility year for the US stock market of all time. And a narrative developed during that year that the market has changed structurally in a fashion that means volatility, and here's that word again, will never come back. Now, I was on CNBC, July of 2017, and the VIX crawler was going by, and it said 9.85 was the VIX level. And that year it was below 10 dozens of times. Right. Usually below 10 lasts for a minute, and it was below for weeks at a time, multiple occurrences. And I was convinced that was not going to endure. And so Scott Wapner asked me, what's the highest conviction idea you have? And I said, I think volatility is going to go up pretty sharply, pretty quickly. In fact, I think the VIX will be above 15 relatively soon. And when you go on CNBC, you might notice I don't go on much TV anymore. I really prefer this to going on TV. What happens is if you say anything definitive, they have the next 8 guests go on to talk about what an idiot you are, how you're wrong, how you're so wrong. Doesn't Gundlach understand the VIX will never go above 15 again? There's this structural change. Well, I have to laugh because it literally went above 15 the very next day. And of course, 15 looks really low by today's standards. I think we've had a regime change on volatility. I think we're having regime changes all over the place. And they fall one after another. Vol was one of the first ones to go. Vol really became systematic in the equity market in the fourth quarter of 2018. I mean, we've had massive volatility for the last 2 years. We've had a bear market in 2018 fourth quarter. Then we had a rally all the way back, in some cases to a new high. And then we had an even bigger bear market. And now we had the greatest 30% increase in PEs, like in history. The 6-month increase in PE was the greatest in history, I think, for the S&P 500 from the 6 months from March into September. So I think volatility is just going to keep escalating. And I think that's a really good thing for active investors. The regime that we've been in, I would say for the last 4 months, is great for like my portfolio. I've got beaten down stuff that's lagging and is now recovering, and it all feels good. But once all that stuff recovers, if you don't have a volatile environment, you don't have any opportunity, because if treasury rates are at 87 basis points on the 10-year, let's just call it 1%, and there's no volatility, what are you going to do? I mean, your dream is to make 1% in treasuries and 2% in corporate bonds. So I'm looking forward to that volatility. I'm hoping, and I guess I'll just hope, I'll choose to believe, I'm not really predicting, I'll choose to believe that this time it won't happen in 4 days and then recover in 4 minutes, which is what happened this time. And I hope that's more like the global financial crisis, where you're actually able to transact with a reasonable bid-ask spread in the global financial crisis. During March of this year, I don't think money investors understand what the conditions were in the markets, particularly the credit market, the bond market, even the treasury market. There literally were windows of time where you could not get a bid on off the run 10-year treasury. You could not get a bid. There were emerging market bonds that simply, the bid was zero. Literally the bid was zero. Nobody would even respond with a bid. In the global financial crisis, the worst days, the bid was 40 and the ask was 45. That's a pretty big bid ask. But in March of this year, we saw in markets, once they reopened after being literally unable to be traded, we saw bid 50, offer 70. So you can't even transact because the value looks great at 50, but it's not real. And at 70, you're sort of like, well, the bid's 50. I mean, I'm not sure I really want to lift that 70 offer. So, and then of course, the market didn't stay in that dislocated condition for very long. So I'm hoping that it gets a little bit more, slow motion, which would probably happen because the COVID thing was such an out of left field. Even if there is, and looks like the COVID stuff is getting a lot worse, and it looks like the only response that Joe Biden's regime, if he gets inaugurated, could have would be very harsh lockdowns. I just don't see how he could do less. His entire complaint is predicated on the idea that the government didn't do enough. So you got to do more. If your whole point is the government didn't do enough, then if you get faced with a similar situation, you're going to have to do more. So I think there's a lot of economic danger underneath the economy with the spike in cases that's going up. I know that in many areas they're running out of hospital space. I mean, these are some real problems. Now, the good news is the death percentage isn't as high. And then you've got this hope for vaccine, which I think is really overblown. I wish it were true, but I'd feel a lot, I would take this news more credibly if they came up with a vaccine and they said it worked like 53% of the time or something. There's something about that 94.5 that just looks fishy to me. You go from 0 to 94.5. I got a feeling that it's a very small sample. I've got a feeling that it's relative to one strain, and these things mutate like crazy. That's the problem with vaccines on coronaviruses, is they mutate like crazy. We can't get a durable vaccine on the regular influenza. We have failure rates of over 50% in some years. And then there's the question of will people take these vaccines? Apparently, the ones that they've tested with these high rates, apparently it's super unpleasant to take the vaccine. Apparently you have to take it twice. It's really painful. It gives you some fairly painful side effects. This is what I'm hearing from people that know more about this than I do. So I saw a survey from Gallup, not that I believe polls anymore, but this was a poll that said, if you were given a vaccine from the FDA and they said they are positive that it's safe, it's completely free, and it's totally available to easily, would you take it? And the answer that said yes was 50%. And that's before they said, and it makes you feel really sick for 3 days and it hurts like hell, and then you have to do it again 2 weeks later. I think it's going to be low. So I think this is a lot of, I'm all for optimism that some such thing could exist, but I don't know, 0 to 94.5 on a small sample in a rapidly mutating disease. I'm going to be from Missouri on this one.
Okay. Let me just jump in with a quick question back to the fixed income. Someone asked about muni bond markets. So just wanted to get it's a pretty generic, broad question, but
if you had a blue wave, munis certainly would have done better. Just again, for the tax reasons. Munis, I think, will probably be very dispersed in their outcomes. If you look at what happened in the aftermath of COVID, you saw a really big sell-off in the muni market, just like everything else. And then you saw the AA rated munis, the single A rated munis, they rallied back fairly quickly, kind of like corporate bonds did. They kind of were on the back of corporate bonds. And I think people believed that under those conditions, the government probably would have bailed out some of these muni bond markets, at least maybe not given money directly for the states as a first attempt, but at least, done a buying program or something like that, as if they've done other things. But I think, you've got to be careful about what munis you own. There are some places, for now, I guess it's okay to own California, but I think it's going to get a lot worse. I think the revenues in California are sure to collapse, thanks to the already highly observable exodus from California. Just Elon Musk, Joe Rogan.
Are you next, Jeffrey? You're
I'm
thinking about it, huh?
researching it. I'm
Yeah.
researching it. It really depends on how suicidal the legislature really decides to be. They have uh, proposals in place that I think are fully suicidal. If they pass them, I think I'm going to have to go into a more aggressive mode of thinking about leaving, because they're talking about a 16.8% tax bracket, which of course is non-deductible on the federal return. And I doubt Joe Biden will return that. He might return it.
You may.
He might return it partially. He's not going to return it for me, I'll tell you that. And so 16.8, and now they're talking about a 40 basis point wealth tax. And that's another proposal. Now, 40 basis points doesn't sound that painful, but we all know how these things go. You start with the frog at 80 degrees, and then it's 85 degrees. The next thing you know, the frog's dead. So I think, I was doing research about Arizona, and it was funny. I didn't even know they had a tax increase proposal, and it passed. And so the highest tax bracket in Arizona just went from 4.9 to 8%. I got news for you. That ain't going to be the last tier, right? They're going to keep going because they have to. So there's a lot of changes that are going on there. So munis, the tax benefit is probably not going to go away. I think if you're in states that are not in complete disarray in terms of their liabilities, I don't see any problem with munis. I put it this way. I haven't bought a muni in 9 years, but I've reinvested. So I haven't added money to my muni portfolio, but I've reinvested. It's all California. So I'm still copacetic enough to have not made any shift myself.
Fair enough. You have a couple minutes left. I did want to shift gear and ask you a couple of broader questions. And one, I guess, is just an update, if you're willing to give us an update on your professional plans or retirement timeline. I mean, I've asked you about this in the past.
I don't think about retiring at all. I mean, if I'm thinking about moving out of California for tax reasons, it sort of suggests that I would have a future timeline of income. If I was retiring, I would just say, well, there's other problems with California than just the taxes. I mean, the infrastructure used to be the best in the country. It's now one of the worst. We said the best school system in the country. It's now one of the worst. The homeless problem is really depressing. I mean, there's shanty towns all over the place in areas that used to be pristine, and now there are shanty towns all over the place. The 10 freeway, which connects the west side to downtown Los Angeles, you drive down there, and if you do it in the afternoon when the sun hits the road a certain way, you get a really good look at how much broken glass and garbage. And I mean, you'd think you're in Bangladesh with the way the infrastructure is. So all of those are bad enough, and they have started to defund the police. They cut the police budget for Los Angeles County. I mean, these are not encouraging signs. So, but the taxes would kick me over the edge for sure. So I have no retirement plan. I've talked about this for years. I have seen from a 40,000 foot overview that we're going to have pretty massive societal change. Our institutions are going to change. There's going to be rejection of the old institutions. I think right now we can say that I've been on the right path in my thinking, that there's been a lot of changes in the way people view our institutions. If you think it's weird now, wait 4 years. Like I said in 2016, I said, Trump's going to win. I said, if you think this one's weird, wait till 2020. Well, I think I was right. I actually predicted there'd be violence in the streets. And then wait till 2024. My point of saying all this is I can see that this is happening. I want to work through it. I want to see the end of it. And I want to be able to see the sunshine when the clouds part on the other side of this hill, because it's going to be really good. But that might take until 2027. So I'm fully, I'll probably be around at least till then.
Okay. My last question is even broader, and it's about, achieving long-term investment success. And, I think it incorporates, my question is, what 2 or 3 attributes do you believe are most important for, achieving long-term investment success? And I think, it's become even more challenging in the current environment, the range of outcomes, the uncertainty, the tales that are coming true, as you said. I mean, maybe violence in the streets in the US.
It's already
We've had that historically, but
already here.
so yeah, already it is here. I mean, we've seen that, you know, it's not the first time, but just stepping back, if you had to kind of give advice to someone early in their investment path to, you know, to be a long-term successful investor.
Well, the first thing is that you should extend your investment horizon. That's the very first thing, especially if it's your own money, because in that way, you don't have to get second guessed all the time. So if you have a long-term investment plan, you should extend that horizon and get committed to certain ideas. And I'll use my placeholder again, India. If you believe in my India thesis, which I'm strongly committed to, that's going to basically do what China did and have a 30x type of stock market return over a multi-year horizon, not 5 years. So we're talking 20 years, 25 years. I think you should start getting committed to that. And then when you have sell-offs, don't be afraid. When you have sell-offs that are significant, add to it. So maybe a dollar cost averaging concept, or maybe, you know, I don't believe in dollar cost averaging. I think it's too mechanistic, but a theme like that where you are adding when it's down, and not worrying about it. That's the hard part, because you could easily lose 30% of your money if you bought India today. You could easily, but I'm talking about the big picture. For other people's money, which is I've figured out how to run that in a way that pleases a lot of clients. You can't extend your horizon that far, because when India goes down 30%, they're all going to pull their money out. So you have to shorten that down to more of an intermediate term rather than a long-term horizon. And for me, that's about 18 months to 2 years is about how it is, which it's another reason why I greatly prefer if we didn't have these car crash markets. Instead, it was more of a slower motion train wreck than a car crash. The other thing, and this is hard to teach people, but you have to try to develop an emotional memory. And what I mean by that is when you experience really bad markets or something really bad happens in your portfolio, you've got to internalize like how it feels, like what the fear feels like, when it becomes palpable, and then remember that. Like I tweeted out late March, I had, by good luck, I had entered the sell-off in the equity market like 300% short in my own personal high-risk thing. And on the day that Bill Ackman got yelled at for going on TV and saying that we were in a depression, the world was coming to an end, and then it turned out he was buying stocks, kind of a weird situation. But that minute that he was doing that and the reaction on TV, I said, this is it. I can feel the way this is behaving. This is like March of 2009. This is like October of 1994 for the treasury bond market. I can see by the way people are behaving. And you have to figure that out on the other side. What totally saved my bacon during the global financial crisis was, I went into it with no credit virtually. So I'm in a good spot. Right. So then August of 2007 comes and the cracks start to form, and the collateral in the mortgage market starts getting marked down. So bonds that were always at 100, they were just AAA rated bonds. They traded 100 all the time. They had floating rate component, and they started to get margin called at mortgage REITs. And one of the best mortgage REITs in terms of their underwriting quality was Thornburg. And it didn't matter that they were the best underwriter. They were just getting margin called. The liquidity was being drained out of the system. And so one Friday afternoon, a bid list came out, and there were these bonds on there. And these were a little bit different. They had some interest rate risk, but they were 6 coupon, fixed rate, 30-year prime mortgage. And they never traded below par. And they were talking, there were hundreds of millions of them on this bid list, and they were talking them at 97. And I just threw a throwaway bid of 93. And they're like, 93? They're never going to trade at 93. And 5 minutes later, I owned 350 million of these bonds at 93. Wow. And one of my, then he's now the head of my agency MBS group, but then he was a younger guy, of course. And he's Russian, and he's got a pretty thick accent. And he's like, this is too cheap. I've never seen it cheap. This is the cheapest bond I will ever see. And I had this crack of doom moment, like lightning went down my spine. And I was like, you know what? We're not buying any more of this stuff. You know, if this thing rallies back up, we're going to sell it. Mark my words, these things are going to trade to yields at least 15 on a payback basis. Because I know how this stuff goes. When you have this one-sided margin call type of event, it ain't over at 93. Well, I made him write on the ticket, this is the cheapest bond I've ever seen. We tacked it up on the wall. And of course, the bond went to 45 cents on the dollar. And it's that feeling of like, wait a minute, I'm filtering this information through a lens of experience with an emotional memory. It's hard to develop, but you have to understand that you're emotional too, and you have fear and greed, and it's very hard for people. I mean, how many people were panicking in the retail equity market in the middle of March? A lot of people pulled out, you know, and now they're buying back at a PE of 30, a CAPE ratio that's the same as 1929, market cap to GDP, the highest in the history of the United States, corporate debt, the highest in the history of the United States. I mean, sort of like, really? I mean, you've sold in March and you're buying back now? You know, at least try to learn from that emotional experience.
Right. Well, yeah, experience is a huge value, and
the problem with the investment business is when you finally get enough experience to feel like you're really good at it, people start asking about your retirement plan.
Well, I had to ask. I'm happy to hear the answer is no plans, but it's always good to check in. So I think we're a little bit over. I really appreciate again your time and obviously your investment expertise on behalf of our shareholders. And
you bet. I'm pretty optimistic that we're going to continue to see some good gains in the months ahead. So I'm happy about that. We'll probably turn into a modest single-digit return for the year, I think.
That would be excellent. So thank you, Jeffrey, and listeners. I'll turn it back to Mike Pacito to wrap up. And thanks again.
All right. Bye.
Bye.
For now.
Okay, well, thanks everyone. Nothing really to add from my end, except we appreciate you joining the webinar today, and we hope you'll join us for the next one. And if you have any other questions about the fund whatsoever, feel free to reach out to us. All of our numbers and emails are here on the screen. Thanks, and have a great holiday season.